Welcome back to Golden Rule Radio. We have had gold up 2 strong days, and we've had gold right back down 2 strong days. And since last week's show, I think we're right about flat. Fed raised interest rates last week. We had a nice rally from the low 1300s right up to about 1355, I think I saw it, and pulled back the last couple days. Here's today, Wednesday, and we're sitting around 1325.
Yeah, we're down 19 today, which is 2.3% off the high. And it's not necessarily point-to-point married to the U.S. dollar rally that we've seen. I don't know that you would even call it a rally, really. Would you, Robert? It's just sort of a little uptick.
Yeah, just above 90.
Yeah, but the U.S. dollar is up a little bit, back over the 90. And we talked about 3 weeks ago, all of us being sort of on the sidelines, waiting to see what happens with these channels. Nothing has happened with the channels, right? I mean, we're still in this same formation, although they are compressing. And I'm as anxious as anybody to see if we break out to the upside or to the downside. And I actually got really excited about yesterday and the day before at that 1355. I thought, okay, there's a chance here we'll see us break above the 1375. It just was not to be yet.
Silver about the same, up a couple days, down a couple days, and probably about the same as it was this time last week.
Which means the ratio hasn't changed. I mean, we're sitting at essentially 81 to 1. I know that some of you are probably getting restless, but stay with us, bear with that ratio, and just trust the fact that owning silver right now is certainly the side of the fence you want to be on.
Yeah, gold-silver ratio, 81. It hasn't really been much higher than about 83, 84. So you've had the pendulum swing all the way up here. You're in this high range. We've been here for a while. I mean, a lot of our clients who switched to silver a couple years ago, still there. We're still waiting for that change.
So we have a little bit of support, wouldn't you say, psychologically and round number-wise at 16, but also technically, and then a little upside resistance. We're going to have a tough time breaking above that 1681, but as Miles always points out on these great charts, we see some downside support, upside resistance, and it does seem to be narrowing.
Speaking of the pendulum swinging with ratios, we are at an extreme with the gold-platinum ratio. Just like the same with the gold-silver ratio being at an extreme high, you have platinum divided by gold at about 0.7. I don't know that it's been below that. Has it? I think we had one time that it was 25 or 30% below the price of gold back in like 1980.
You're talking 40 years.
Long time ago, and it has swung all the way down here. And could it go farther? Sure. Sure it could. But you're at a point where from where it is today at 0.7, again, taking the price of platinum divided by the price of gold, you're at 0.7. Taking that ratio where we are now and moving back to only where it was just a few years ago, like 3 or 4, I'd have to look at the chart to be exact. It was at 1.1. I think it pushed to 1.15. That's 40%. That's a 40% change just going back to an abnormal level that it was at then. Not to mention if you back up another 8, 10 years, something like that, platinum was 2 times the price of gold.
Yeah, I remember back in 2008, the summer before the economic crisis really had turned. So you're looking July 2008, we were double the price of gold. Platinum was literally, it was a 2-to-1 ratio, to your point, Robert.
I don't think a lot of people are paying attention to that. And so if you're listening to the show, you'd be an early adopter of taking a position in platinum, exchanging it to gold when it even goes back to par 1-to-1, or wait till it goes to 1 to 1.1. But you're there, platinum's a buy.
So leaving the metals, moving on to other markets, we've mentioned briefly the U.S. dollar. We're back above 90. Okay, not huge, not a great big move.
Not even up to the trend line that was a descending trend line, not even up close to it.
Which we thought we would break above. There was actually a little bit of a chance that we thought we might, but it's showing really no strength here. And yet the rest of the commodities are. As the dollar has remained down, you've seen commodity prices rally globally because most of them are measured in the dollar. So keep your eye on inflation. It doesn't always have to be in the United States. A lot of times it's on Main Street in country X. So, they get hit, we export our inflation, keep an eye on that, and then get ready for it too. If the tariff war picks up and runs up in speed, then you'll actually see prices hitting Main Street USA, certainly more than what you're used to seeing, but what the rest of the world is used to seeing.
Moving to the equities markets, we have the NASDAQ down big time yesterday, Facebook is in the news, as if you haven't been paying attention and seeing that. Maybe you've asked Alexa to tell you about what Facebook is doing in the news, because that's probably the next pressure point that Trump will hit is Amazon. And so is this large enough to have the tech sector actually cause the next decline? I think so. There's so much overvaluation that you can't even determine what the valuation is of these tech stocks. It's so inflated already that a real valuation is very hard to determine.
I totally agree. And it's actually, these values are nebulous. It's like they're just thinking, how high could it go from a speculative nature? And now you're in an environment where if the tech stocks begin to tumble, there is no way to value, to your point, right? And then you also end up seeing the fact that there are really no assets. So these are all supposed assets, mainly in the form of advertising monies. Well, if people aren't wanting to advertise, then how do you determine a value? Again, I'm with you. The cover of the Wall Street Journal today has some very heavy-duty charts to look at that shows the tumbling in the tech sector. The last time we saw a major tech correction prior to 2008 was that 99, 2000 area. And it did. You're right, Robert. It drove all the indexes down. It took them all with them. Tech stocks, too, Robert, are just an indication of the real fear that remains in the equities markets, right? It doesn't have to be a dot-com bubble that's bursting. We're 10% down from the highs in just the Dow Industrials, okay? And so that doesn't necessarily represent the tech stocks the best. However, that's halfway to officially bear market territory. When we get down 20%, it doesn't have to happen overnight like a lot of people think. You're 50% of the way there on these declines. And there is a lot of fear. There is a lot of uncertainty in the equities markets. And we were very, very close from a Dow theory standpoint of confirming an official bear market from a Dow theory standpoint last week, just Friday. So anyway, keep your eyes on that and read more than just the mainstream media.
We're going to keep this a very straightforward week and wrap the show today.
A couple things to keep your ears open on. Obviously, North Korea and Chinese negotiations, tariffs picking up, and then anything geopolitical as tensions build, mainly in that Syria hotbed between the U.S. and Russia. But please subscribe by clicking the button below.
Follow us on Twitter at ICA Gold, or if you'd like to engage with us over the phone, give us a call, 800-525-9556. Have a good week.